upbeat. What if your money could work for you? What if every dollar you saved had the potential to grow, multiply, and secure your future? Welcome to the world of investing. Whether you're saving for retirement, your dream home, or just trying to grow your wealth, investing is the key to making your money work harder. First, let's define what investing really is. Investing is the process of putting money into financial assets or ventures, like stocks, bonds, or real estate, with the hope that over time, your money will grow. Unlike saving, which is often about short-term goals or keeping money safe, investing is aimed at long-term wealth building. And the best part? Even small amounts can grow significantly with time and the power of compounding. Before we dive into specific types of investments, here are a few key concepts you should understand. All investments carry some level of risk, but generally, the higher the potential reward, the higher the risk. Stocks and cryptocurrencies, for example, can give you high returns but are more volatile. Bonds, on the other hand, are considered safer, but they offer lower returns. The longer you can leave your money invested, the better it can grow. This is called your time horizon. If you're investing for retirement 20 years away, you can afford more risk. If you need the money in 5 years, you'll want to be more cautious. Diversification is simply the strategy of spreading your investments across different asset types. This reduces risk because if one investment doesn't perform well, others may balance it out. Let's start with real estate. Real estate investing involves buying property to generate income or appreciation. You can earn money in several ways, such as buy a property, rent it out, and collect monthly rent payments. This generates steady passive income. As the property value appreciates, you can sell it for a profit. Some investors buy, renovate, and sell properties for quick profits, which is known as flipping. To get started in real estate, research market trends and secure financing. You can also decide whether to manage the property yourself or hire a property management company. Next up is cryptocurrency. Cryptocurrencies like Bitcoin and Ethereum are decentralized digital currencies. They rely on blockchain technology, which is essentially a public ledger of transactions. Cryptos are famous for their high potential returns. Early Bitcoin investors, for example, saw huge profits. Since cryptocurrencies are decentralized, they're immune to inflation or manipulation by central banks. But remember, cryptos are highly volatile. Their value can drop as fast as it rises. Make sure to diversify and store your assets in secure wallets. Now let's talk about stocks. When you buy a share, you own a small piece of a company. Stocks offer the potential for high returns, and you can earn money in two ways. The value of your stocks can grow as the company becomes more profitable. Some companies pay out dividends, which is a portion of their profits distributed to shareholders. To get started, open a brokerage account, research companies, and diversify across different sectors. This reduces the risk of losing money if one industry struggles. Transportation is a crucial sector in the global economy, involving airlines, shipping railroads, and logistics companies. As global trade grows, so does the demand for transportation services. Many transportation companies are publicly traded. You can invest by buying their stocks. You can also invest in transportation-focused ETFs, which are a basket of transportation stocks. Keep in mind factors like fuel prices and economic cycles, which can impact the profitability of these companies. Bonds are essentially loans you give to a government or corporation in exchange for regular interest payments. Bonds are a safer option compared to stocks and can add stability to your portfolio. These are issued by national governments and are typically considered very safe. Companies also issue bonds to raise capital, and they usually offer higher interest rates than government bonds. Adding bonds to your portfolio can provide steady income and reduce overall risk during volatile market periods. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other securities. They're professionally managed, which means you don't have to make individual investment decisions. Equity funds invest primarily in stocks and are aimed at growth. Bond funds focus on fixed income securities and are typically less risky than equity funds. Index funds track the performance of a specific market index, like the S&P 500. Peer-to-peer lending allows you to lend money directly to borrowers without going through a bank. Platforms like Lending Club and Prosper facilitate these transactions. P2P lending offers the potential for higher returns than traditional savings accounts or bonds. However, there's a risk that borrowers might not repay the loan, so always spread your lending across multiple borrowers to minimize default risk. Commodities are raw materials like oil, gold, or agricultural products that can be traded. Investing in commodities can serve as a hedge against inflation and provide diversification. You can invest in commodities directly by buying physical items like gold bars or indirectly through commodity ETFs and futures contracts. In conclusion, investing offers endless opportunities for building wealth, but it requires careful planning and research. Diversify your portfolio, stay informed, and align your investments with your financial goals. Whether you're just starting or looking to expand your investments, the key is to be patient and adapt to changing market conditions. So what are you waiting for? Start investing today and let your money work for you.